My experience is that you meet one person in Israel and they say, here's 10 people you have to meet. And you're like, well, my schedule is booked, so I'll have to come back. And then you come back and then they go, each person you meet says, here's 10 people you've got to meet, and say, oh, I already know two of them. And then you come back and eventually they go, here's 10 people you have to meet. And like, actually, I know them all. I know them all. I know everybody now. And it's just an amazing, it's actually a magical startup ecosystem and vibe and like mission driven everything. But let's talk about valuations. If you're investing in like kind of a seed deal that's got that kind of revenue traction that you discussed, that's pre-Series A, what would the valuation be for guys like you that are going to fund it when it's in Israel and then fund it again when it maybe moves to the US? Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and today we're speaking with Andrew Gershfield, who's a partner and co-founder of Flint Capital in Boston. And they also have offices in Palo Alto and Tel Aviv. Andrew, great to see you. Did I get that right? You're in Boston, you got Palo Alto and Tel Aviv. Am I missing one?
Actually, we're not permanently based in Palo Alto, so we don't have an exact office there. We are in Boston and Tel Aviv, so that's two our major hubs, and it actually corresponds with the strategy we actually do at Flint.
Okay, yeah, so let's dive into that. I mean, we'll talk about your journey. I know you're a candidate at the Kaufman Fellowship. I'm curious to hear what your experience is there. If that's like, most people I speak to love it, but I'd like to hear a little bit about that. But let's start with the strategy. So I think you guys are investing out of Fund 4 right now. I think you were saying that you started investing in 2013, but then you fell into like a Fund 1 structure by 2016. Maybe tell us, what are you investing in now, kind of stage, sector, geography?
Yeah, sure. The main idea behind all the funds is that we try to help entrepreneurs that emerge outside of the US to get to the US market, and specifically in the domain of enterprise software and B2B. So the majority of our investments, given that kind of focus, they come from Israel, and that explains why we have a Tel Aviv office actually. So I would roughly say that in initial funds, our strategy was less defined. And we had a lot of different experiments around what kind of investments would we be doing. We've done a lot of consumer mobile things, and quite successfully, but learned a lot from that. We did a lot of experiments around, I would say, new technologies that were buzzwords at different times of things, and learned about those fields. But the bread and butter and the thing that we actually understand lies in the B2B space. So currently we do invest in infrastructure, software. We do invest in B2B applications, enterprise applications. We do invest in cybersecurity. We do invest in health tech. And as I explained, we like entrepreneurs that are actually reaching out to the US market from outside. So we do investments in Israel, but we also do investments in Europe. We do investments in European founders, I would say, but we do investments in Canada. And those founders, we help them bridge the gap between their local ecosystem and the US, bring them to the US, help them start their business here, and like expand their capacity in the market, and raise capital from the local investors. So that is the major kind of strategic view. In terms of stage, we do early stages, typically later seed, Series A, with ticket sizes varying from, I would say, 2 to 10 million, depending on the stage of the company. On average, it is something about 4 or 5 million, depending on, again, the circumstances, the market they're reaching, and the kind of setup we're talking about.
So for just to zoom in on stage for a bit, from your website, it was looking like Series A, Series B. So it's like relatively later stage, but you also do some pre-Series A investing. And if you're bridging the company from Israel, Canada, Europe, and bringing it to the US, I would imagine you're getting in before the Series A. How early, or like maybe just talk a little bit about your portfolio construction. Like how many companies do you expect to have in a fund? How many of those would be pre-Series A, pre-revenue, if you do that at all, and kind of like how do you balance that? Are you 70%, pre-Series A, or are you 10% pre-Series A?
The typical structure is the following: that we aim to have about 20 to 25 companies that are at the stage of later seed and Series A together, and with that type in each fund. And that type of portfolio construction helps us to get to the numbers and to the economics that we would expect from early stage funds. And in terms of pre-revenue and other kind of things, the philosophy is that we usually try to invest in the companies and founders that have kind of minimum product in place and early customers. Maybe they're not generating revenues, but they still have enough confirmation of the enough market validation at some level. We like to understand that their customers are engaged with their product. The product is good enough that actually, even if it is not perfect, but the customers can suffer that pain and still be using it and still be interested in working with them, like as a design partners, or I don't know, through the proof of concept stage. That's the indicator for us that it is going right way, and also it shows out that the team actually is able to execute through certain steps in the life of the company. So I would say that the pre-revenue part of our investment would correspond to roughly 40% of our initial checks that we write. Maybe a little bit less, but it depends on the situation. But roughly
40% of your capital, 40% of the capital, or 40% of the logos?
40% of the initial checks. So our funds usually structured the way that we have like 60% allocated for initial checks and 40% allocated for follow-on investments.
Okay. So you establish a portfolio of roughly 25 companies that are clearly pre-Series A. You got reserves of 40% to double down into winners in pro rata or super pro rata.
Yeah, right.
It's basically the model. And it's funny. So I've been in the venture world. I've been in the venture world my whole life, but the Founders Club was an equity exchange fund. And so I didn't have a normal classic 2 and 20 fund investing until 2014. So your experience is not that different than mine. Maybe a little, you started maybe a little bit later investing out of a normal fund. I've been doing SPVs my whole life. Like I've been doing SPVs my whole damn life. But what have you learned that like you're doing differently? Because like similar to you, I founded my own fund, so there's probably a lot of similarities. But for example, I've invested in companies that I don't want to say their names, that are return the whole fund investments. So you can't complain. That one investment will return the entire fund plus. But I wouldn't invest in those companies now. Like we're just getting increasingly focused. So like for you, what are you doing now that's clear that you weren't doing in the beginning? Like, would you invest in a Boston-based company that was just born here, a couple guys that went to Andover and then, went to Harvard, or are you really focused on bridging companies from outside in?
We treat our fund through like it's very, very important to remember where you come from in terms of your experiences. And as entrepreneurs ourselves, all the founders are entrepreneurs in the past. We still continue to treat our investment firm, as a startup at certain angle. So we always leave some room for experiment. So I would never cross draw the line and say that, well, that is what we would not do. But we tend to do things that are more focused in the space that I have just described. But yet, still, we can do and write check to the Boston-based company that, as you mentioned, like by MIT or Harvard founders, etc. Why not? Like if it fits, if it meets other criteria of our focus, where we understand that we can bring value, and where it is the domain of expertise, enterprise software, as I mentioned, cybersecurity, whatever. Yeah, definitely. And we in Boston, it's a great ecosystem in Boston to look at, and we usually benchmark all other companies that are coming to us through different channels from different countries, with the US-based peers and with other companies that we are seeing from New York, from the Bay Area. So the amount of deal flow we are getting is broad enough to compare apples to apples. So I would say it's not cut in stone.
Okay,
100%.
so there's some flexibility there.
Yeah.
So I actually have a lot of experience in Israel. I used to go all the time, and I back then I would stay the whole week, and I didn't even have like a bathroom break in there. It was a solid meetings book before I got there. And my experience is that you meet one person in Israel, and they say, "Here's 10 people you have to meet," and you're like, "Well, my schedule is booked, so I'll have to come back." And then you come back, and then they go, each person you meet says, "Here's 10 people you've got to meet," and say, "Oh, I already know 2 of them." And then you come back and eventually they go, "Here's 10 people you have to meet." And like, actually, I know them all. I know them all. I know everybody now. And it's just an amazing, it's actually a magical startup ecosystem and vibe and like mission driven everything. But let's talk about valuations. If you're investing in like kind of a seed deal that's got that kind of revenue traction that you discussed, that's pre-Series A, what would the valuation be for guys like you that are going to fund it when it's in Israel and then fund it again when it maybe moves to the US? Is it like, are you getting a good deal? Because valuation and inflation is not only like at the grocery store and the gas pump. Inflation in my 20 plus years of being in the startup ecosystem has gotten out of control to the point that, you got to be careful to not be investing at a too stupid a valuation for a company that's got early stage risk and the exit points. And the exits are bigger too. Like AdMob, 800 million. That's like a pre-money valuation these days. And you think of AdMob as like a transformational, YouTube.
Yeah.
I mean, like, so there's inflation on the exits, but talk about Israel versus Boston, Palo Alto, New York.
Yeah, sure. You're absolutely right. Noticing the kind of ecosystem Israel is. It actually, everyone knows everyone, and to be a successful investor in Israel, it also means that you should be perceived as the part of the ecosystem yourself. And it's very easy to make any reference checks in Israel, and usually. What we do and what we encourage our founders to do towards their investors, prospective investors, is to do reference checks, but not through the kind of context they provide, but through the kind of context you can actually,
yeah. So we call that offsheet reference checks, like not on the sheet, like.
Yeah,
when we do reference checks, we're not asking the founder to give us the name of the person and their phone number.
We typically ask and not call those people.
Yeah. Israel, I think Israel is a good role model for the whole world of you just got to spend the time to do other people favors, or else you're going to get kicked out from the ecosystem. So you just got to keep pushing it forward and helping other people, and that good karma will come back to you. That good karma will come back to you.
Yeah, right.
But specifically on valuations, like give me some numbers. Let's say a company's got 100,000 MRR, so they're at like 1.2 annualized revenue, and they're growing. It's B2B SaaS, and the company has got customers in the US, and now they're ready to hire in the US and maybe flip. What does the valuation look like for a company like that coming out of Israel? What is the valuation for a company like that born out of Boston?
As I've been observing through last 10 years, I would say that Israel was like a little bit behind the US ecosystem for a long time. But then was some kind of point, and I would say it's around the COVID, but I can't say it's because of the COVID or after COVID, all the hype and a lot of tech happened at that moment. But actually, it started before COVID. The Israel started to catch up with valuation marks and with multiples with the Bay Area and East Coast. The part of it is that the Israel GDP is very dependent on software and tech industry, and actually a lot of jobs created in that field. And actually the success stories for most of the Israeli entrepreneurs is like building a software company, going to the US market, raising money, and all the kind of story. So it transformed into a very, very hot market on both ends, on the end of building startups, but also on the end of actually job market for the startups, software developers, other kind of experts, marketing, sales, etc. So I think currently we're observing kind of correction in that field, but and I would say it slowed down a little bit, and but it lags behind to what's happening in the US. So US was the first to get into the hype and to the upper end of valuations. Israel lagged behind a little bit, but now US is correcting and more reasonable. We see more reasonable valuations and the benchmarks. At the same time, Israel is still hot in several spaces. I think that it is all for a reason that I described: the lack of like the hot job market and the expensive talent, but also because of good successes that actually come from Israel as an ecosystem in the enterprise software field.
Yeah, you know what I think? I think that if you really know what you're doing, and you've got boots on the ground, you've got local Israelis that are deep in the ecosystem, you can get a good, fair valuation investing locally at a pretty early seed level. And then if it's like something hot like cyber, I mean, look, Checkpoint is like one of the original Startup Nation, exits.
Yeah.
If you've got a hot Israeli cyber company that flips to the US, all of a sudden it gets really high. So like almost like blockchain, in my opinion, slightly overvalued. So there's a trick of investing in the company when they really need the first investors, and then it can go up pretty fast. And you kind of have high, quick TVPI, MOIC up marks. It's a bit like investing in the YC company during YC and before demo day. It's almost like that.
Oh, yeah. My observation is that this kind of arbitrage of the markets is not there anymore. So I wouldn't say that Israel has built a cohort of very talented entrepreneurs, and there are many of them, and they know a lot of and as we talked before, everyone is helping each other, and that is the great ecosystem that shares a lot of knowledge. So it actually enables people to understand how do things and how to prepare and how to build the company at this early stage to make it more valuable. So typically what we see is that this gap in valuations, it's not actually what matters. And we actually don't look at, so we have developed the kind of philosophy that we don't look for a cheap deal, because usually the best deals, they never cheap. So we usually try to develop the relationships with founders that actually are up to something and that have a potential to build something great, and we don't care too much how to pay or how much to pay to do business with them. We try to develop like a value approach when they see that they are comfortable working with us in many aspects, like a founder-friendly investor from the US that is actually understand the local ecosystem, but the gap of that they will have to close coming to the US. And founder-friendly is important here. It's been a term thrown everywhere, but I think understanding how your investor would work with you when things are not going the best way they could is very important. And to understanding how the investor can help you at certain situations, and when if they are valuable for you, if they are focused on you, because like some investors we have 25 companies in one fund, but some investors have like 25 companies each, like, or whatever. So I would say that the valuation discussion is typically not the part of the major concern for our deal making in Israel, but more the potential and the capacity that founders have to build a company that actually will return the fund.
I think it's important to get valuation correct at a minimum, to understand that, let's say you get a 24-month cash runway or an 18-month cash runway, that they will be able to progress from where they are now to where they're going to be in, say, 12 months, where you still have 6 months cash, or maybe you run more than 12 months and you had a 24-month runway. So maybe you run 18 months and you feel like, even in the worst case scenario, they're going to have made enough progress that we can raise a larger amount of funding at a higher valuation. If you get the pricing wrong, you're at risk of being out of cash, having to raise money, and you have not, made enough progress to even grow into the last valuation. When the the bright shiny object, even like, revenues kick in, and that's sort of a certain kind of reality, and you have to really explain why the valuation is going up, even though the Bunsen burner science experiment doesn't really seem to be proving the thesis that customers are ready to buy this stuff. So I mean, but you're right. One of my lessons learned was failing to convince my partners to come in at some high valuations of companies that, that took off. I said no to the seed round of SoFi, which was 340 million or something pre-money valuation, when they hadn't started to do anything yet. It was all just a plan for a Harvard alumni to fund the next flock of Harvard MBAs with student loans. That was the, and I was excited by that, but I was like, gee, 340. If we sell at 6 billion with 50% dilution to me, I made a 10x. Is it really going to sell for like 5 times of YouTube? So sometimes you got to be careful. But I think the biggest thing is to make sure that it's going to be a walk in the park to raise the next round, and it's never a walk in the park. But I want to talk a little bit about your expertise in bringing companies to the U.S. What works? What doesn't work? Like, what are some mistakes? I remember maybe 20 years ago, almost, I was helping Benny Arbel with My Things from Tel Aviv raise money. And we actually got Excel in there. We had Kayak Raylander on the board. He was on the board of Facebook at the same time. Benny would say that he lived in Palo Alto. And I said, do you have kids? Where do they go to school? And he's like, all right, you got me. I live in Tel Aviv. So he was kind of pretending to be in Palo Alto, and I instantly figured out. And then he spends a lot on airplane tickets.
Yeah, right.
What works and what doesn't? I mean, do you keep how much of the do you have to transplant the heart from Israel to the United States, or do they stay there and they just hire a sales team? What works, what doesn't?
Yeah, what we have seen is that actually, if you want to be here in terms of significant revenue generation from the US market, you have to be here permanently, feet on the ground, and to do sales yourself. So we encourage founders in early days to go and do sales themselves in the US. And the reason why we do that is that one of the major challenges for a new company, US company, outside company, no matter what, is to hire good salespeople. And really good salespeople, they would be tending not to join early stage startups because, well, too much risk associated with that. And sales, they have to they still don't know if the product will be good enough to be sold, and they don't want to waste their contacts and their phone book for some startup, especially coming from abroad. So when a founder comes and starts selling, actually it creates a certain level of culture and leadership that enables to build a sales infrastructure around the founder, and build the marketing and get the early team members that would support that growth. So in majority of cases, I would say moving at least one of the founders is very important. And typically it's the guy that do sales marketing, or technical team is not that necessary, but like sales support engineers, they can be hired anywhere. The core R&D typically stays in Israel, but depending on many other things. But sales and marketing is something that you have to develop locally, and it's very important to be near your client.
And is cost of living? I've not paid attention to cost of living in Israel.
Tel Aviv is the most expensive city in the world right now.
Is it? I mean, it's a great city, but so is there any? So there's no discount for having your engineers?
No.
In Israel, if anything,
No.
they think pretty highly of themselves.
Yeah.
Yeah. Okay. So it's a bit of a talent war. It's a bit of a talent war there as well. Herzliya and all that.
Yeah. Right.
And all those places. Okay.
Mm-hmm.
And so, what's exciting you the most technologically right now? Like I know you guys are broad and you're free to do what you want to do, but technologically, what are you the most pumped about right now? What's the dream investment that comes next?
Well, I would say that like you see, the most recent news and the highlight of this year is actually AI wave that we're riding right now. It's a little bit overhyped, but on the enterprise side, it actually brings value. We've seen, first of all, there are a couple of public endorsements of AI, like BCG made some study with OpenAI showing that it actually increased the productivity of BCG consultancy, like 40% for those who was using AI.
Yeah, it was pretty obvious that consultants would be among the first to get illustrate actual dividends. But on the engineering, it's crazy what's going on.
Yeah,
Go.
but I have a couple of other evidences that show that from our portfolio companies, we've been investing in that field for a while. And so, for example, one of our portfolio companies doing sales, operations, and automation for pharmaceutical industry. They actually those 40% look like a very tiny fraction of what they actually achieve for their clients in terms of increase. Like, imagine if just implementing the software can increase your sales for a blockbuster drug that is like $1 billion or $2 billion drug annually, but just 5%. How much would you pay for that software?
Yeah, yeah. We have a similar. We invested in Ryan Welsh's company, Kindi, along with like Dick Kramlich and Pivot North and Intel. It's well-funded company now, and for the pharmaceutical industry, their technology can read clinical trial data in seconds, right? Like the computer can read clinical trial data the same as a PhD woman with 25 years experience in Basel, Switzerland. And that woman in Basel, Switzerland costs like $250,000 a year, fully burdened is the cost. And they have a team of 12 of them slowly reading documents with expertise. And Kindi can do this in seconds, to the point that side effects that are being discovered in real time can in real time be disclosed in, what are the side effects? Does this cause balding or dizziness or whatever? It's like bringing the pharmaceutical business to a whole new level. And, every day a drug is not being put in your grandfather's mouth, that's considered $1 million of lost sales per day. So if you can collapse the time to get, stuff out the door, it's a big value prop. So the startup should theoretically be able to sell an annual license to, Pfizer or Novartis, for a price point that saves the work of all those people. Plus it's collapsing the time to get it out. It's getting to like, smart contract, programmatic compliance. I think it's pretty damn exciting. So I think that it's overhyped in a way, but it's not overhyped in reality. And when it comes to software engineering, like people spoke in the early 90s about rapid application development.
Yeah.
And, and the object-oriented software design and like kind of using Legos to build stuff. But it's truly Legos now of like, the programming interface is just becoming English or German. I want you to stitch together. So we're seeing a lot of companies that like, okay, if Kayak were built today, it would be built completely differently than the way it was built then. And it'll be at a fraction of the cost. You need less funding. Every engineer is a Bruce Lee 10X engineer. So it's pretty interesting to us too. You were talking about, what are you guys doing that's different? And maybe talked about the genesis of how to raise a fund. I think a lot of people that listen to this podcast, are trying to raise a fund or thinking about raising a fund, and you did that. How did you raise your fund? And then we'll talk about, and how does that make the venture capital landscape different than Kleiner Perkins raising money from endowments and pension funds?
Yeah, right. It's as you might know, the most difficult thing is to raise your second fund typically, and maybe third fund also, meaning that when you raise your second fund, you have your first fund, but it haven't yet been mature enough to show like prominent results.
And how institutional were those LPs too?
Yeah,
this is where you and I probably have a lot of overlapping experience. Like, what was the profile of the LPs that invested into Fund One?
Yeah, so one of the major ideas we put behind the fund was that as entrepreneurs ourselves, we saw the value of the network that was helping us with other entrepreneurs who actually been there, done that. So actually who understand what it takes to build a software company. So we reached out to those, and we said we want to build a fund that helps people entrepreneurs to build software companies like you did successfully. And majority of our LPs, they are tech entrepreneurs that are still in business. They run their companies. They have a capacity to invest significant checks because like their companies are public on NASDAQ, but they're still in business, so they don't have a capacity like to manage investments. But they like the idea that they might be helpful in accelerating kind of ecosystem that thinks similar, shares similar values, and can like stand on the rails of their success at some point. So when the founders get capital from Flint, they also get the access to or majority of our LPs in person who are tech entrepreneurs. And I need to know that I think like 100%, or maybe let's make like some caveat here, but like 95% of our investors are tech entrepreneurs that are currently still in business. So that's
it's very similar. It's very similar to us, but we've, thank God, evolved a bit. Like the number of LPs that we have, which across 4 funds is well north of 100. They are value added to the entrepreneur, but the biggest checks that we've taken into our funds have evolved to like wealth management advisors that manage billions of AUM, and they have like 150 million for this, and like they're putting 20 million into our funds, or other ones are doing 2.5, 5 million checks. Whereas like we have a number of LPs from Israel that are like 600K, 500K. And the tough thing about them is that they might do 2 or 3 funds in a row and be really excited. And then they realize they're getting old. You know, they're like, how long is this going to really take? And that's why we've had to innovate to come up with models to return the fund a bit faster, with a little bit of selling to ourselves. Like we'll do an SPV, we'll do an SPV, and then to invest into the late stage growth round. Because some guys are happy to make a 2x in a year or 4x if it drags on, but that would radically push down our fund, which is doing 10x net of management fees. So what we're doing is we're selling to ourselves. So the fund sells like 10%, and then a subset of the LPs buy into the SPV, and then we try to minimum 1x the fund before we ask you for money again. That's what we've had to do. Whereas I don't think Kleiner Perkins would ever do that, because they got like money from the New York City Police Pension Fund, who's going to be paying cops a pension 15 years from now. And so if it takes 15 years to wait for the lockup after the IPO, God bless Kleiner Perkins. But this is the hard thing. Try to get money out of that same guy in Tel Aviv when you haven't 1x yet the fund back to him, or he's now he's like 68 years old and he's thinking ahead, and he's maybe got high blood pressure.
But the thing is that when we talk to LPs, we usually talk about long-term strategy of the fund, and we usually talk about the long-term strategy of the firm itself. So we never like talk about, okay, this is the fund, you should put money in this fund. We say, well, there is a firm, we generate these returns. Fund is just the form of like building the cohorts of investments. So what's your what could be the annual allocation of your capital to that type of asset class, early stage venture capital? And we work from there, meaning that the people who we're working with, they think not in a I put money in this fund and I will wait for returns. They think about, okay, I'm generating X hundreds of millions a year, and my allocation to venture class is that, and I can allocate to certain fund annually that amount, and we're working from there. So we're working in the way that we know the commitment, it will be lasting. It will not be like for one fund. It will be commitment for a series of funds, unless we don't deliver and they get unhappy. So it's not their pension money for their own. It's the strategy behind like managing the class. So yes, definitely we do family and friends in terms of like smaller checks, like you mentioned. But typically we try to have at least 2 million commitment, at least 2 million commitment in one fund from an investor. So I would say that in terms of thinking of capital, institutional capital, they more or less think that way. Like when they make a decision to invest in certain managers, they make a decision to invest in this like prolonged relationship. They don't want to like do this work again and again, reevaluating the management capital.
That's why we do take the, say the accredited investor angels in to grow the network, because that becomes almost our secret weapon, our total differentiator. But the institutional investors are far more dependable to commit to a couple of fund managers like you, like Flint and 7BC, to be in every vintage. And even like Andre Yegi is the co-founder of Advec, which is over 10 billion plus fund of funds from Zurich. That's all venture capital. And he was the chairman of my previous company, the Founders Club, and he's in every vintage himself. And he was saying the key to being a successful fund of fund venture capital LP investor is to be in every vintage. Like you don't know which benchmark is going to get Google. So you got to make sure you're in every vintage and to kind of plan for that. That has not been our experience with our individual friends that founded a company, sold it to Amazon, made a lot of money, and then has a family and a spouse and a plan, and he's getting older, so they're less dependable to be in every vintage. And they often have very specific liquidity aspirations for their existing, businesses that they're involved with, like a normal guy in Tel Aviv, his life will change if like he was an angel investor in Waze. Like Waze breathed a lot of life into the venture ecosystem when that happened with Magma, So what are you guys doing? So that's a little bit on the LP side. What are you guys doing that's different? So there's a lot of VCs out there. How do you think of Flint as, every individual is unique, so therefore every partnership is unique, but how are unique or different?
Yeah. Relevant question. Like I would suggest to summarize a lot of things we mentioned today. First of all, as I said, this entrepreneurial rails. So we can look at things from both sides, like from entrepreneurial side and from investor side. So we actually try to be those guys that understand the challenges, and not only business challenges, but also like emotional challenges and life challenges that entrepreneurs face when doing business, especially in the setup as we described, when you try to bring overseas company into a big market like US. And that is a part of the thing that I would say not that many firms can be distinguished with. And also the piece that we say that that we already discussed with our LP base, that is actually the playing coaches in the market, and can give a lot of boost and to any entrepreneur they meet or talk to. So that is the network that actually is unique by itself. And the other thing is that a lot of people promise that they actually would be helping and etc. The real matter is if you are doing your best to help, What it means is that actually you have to be there for the founder 24/7. Every founder that I work with has my WhatsApp, Messenger, whatever. Uh, I I try to keep the conversation going every 3-4 weeks with every founder I'm in work with. They can call me almost every time on the day. I am in the US. Some of them are in Tel Aviv, so the time difference, is the thing. But people can text me and say, "Can we talk now? I need to talk something through you," and etc. Also, Israel works on Sundays, so it's another piece of thing.
Israel typically works after dinner. In my experience, they say, "Hey, I gotta go because it's 7 p.m. here. I got my dinner on, but I'll call you at 9 o'clock." And that's just part of the luxury of living in the world's most expensive city. Is that they tend to work, and that's when I was on the West Coast. I migrated to Austin, Texas during COVID, but I'll tell you, being in Boston, those 3 hours are so much easier on dealing with the Middle East time zone.
Yeah. So just being there for the founder, always on call, as we say, is it actually makes a lot of difference to other investors too. So I would say the combination of the things, and our philosophy is that we don't push anything, but we are always available. So that means
that's founder friendly. And have you developed a way of ensuring communication between your valuable LP layer and the portfolio companies? Do you animate the network? Have you come up with some specific ways of doing that?
We try to address questions on a type of as needed basis, because majority of like the specifics of the business that our entrepreneurs are doing, you need to route it to the right place into the ecosystem. So automating that part is still like a question. We always have a question around in the team. Maybe we should dedicate someone like making this routing and collecting all the asks and presenting them to the peer of advisors, or we do it on our personal basis. But because we actually, as a firm, at the general partners, we have our own connections to both sides, like to founders and to LPs. Sometimes we just route it through our own network. I wouldn't say we have yet automated a lot, but yeah, it's a constant discussion on how you should do that.
We're certainly not automated, but we always do a couple of events throughout the year where we invite the LPs, we invite the portfolio companies,
like building the platform for open conversations and etc.
Well, just it's a serve drinks, so people are of alcohol, and then they're just mingling. Then we sit down, and everybody introduces themselves in like under 30-60 seconds. And that's quite interesting. Then after dinner, the networking continues, and people are like beeline for like, oh, that guy's the founder of Jefferies Bank. This is the guy who sold his ad company to Facebook, and that's the ad engine at Facebook. I need to talk to her, like that. And it's a little painful, but we've started doing a monthly newsletter to the LPs, and we found that they want to hear from us every month, and it actually is valuable because it kind of forces you to do a little more LP reporting of call the founder when you're in your car or something, and then find out, is there anything you want to include in my monthly newsletter to the LPs? And they're like, yeah, does anybody know anybody at Disney or something? They have something that they want to know. And then something inevitable. And like, I've even gotten to the point of like starting to put the founder's email, because there's just too much going on for my inbox and my death by Zoom and, travel and everything else. But listen, Andrew, I want to finish up with Kaufman. You to quickly describe like how that works, and if you recommend it to other people, like what are you getting from it? What happens there?
Yeah.
And then we'll wrap up.
I would, yeah, sure. I would top up a little bit to the previous question, because I was thinking you were like referring to more like some kind of software platform or something like automated channel. But as a platform, as a social platform, yes, we do a lot of things in Israel. We run kind of networking events where our founders, potential founders, and our co-investors and angel friends come to the dinner, and then they do something like that. We also been very, very happy in doing some kind of sailing exercise with our investors and founders together. When you sail, you can do things. You can communicate on informal grounds. And the barriers, you don't need alcohol for lowering the barriers. Cool. Yeah. So we do that actually. Typically, it's once in a year, because it requires a lot of arrangements, travel arrangements for everyone. Yeah. So on this field, and in Kaufman, a lot of those ideas actually came out from that program. So I'm a big fan of what guys at Kaufman are doing. It is very helpful in terms of establishing certain kind of values behind the players of the ecosystem. So everyone would, it's like, and VCA is the legal framework for the venture ecosystem to operate, and it makes it advocates the ecosystem in many ways toward the government, and sets the legal framework for VC. Kaufman is, I would call it, a value framework for values framework for VCs. People who have passed the program, I would definitely say that they share a certain kind of approach to what they're doing, and that makes very easy to work and communicate with those who've been in that program. And I think for me it was very important part that they are exposed to every corner of the world right now, and you get a lot of perspective from the countries that you would not be considering as your business, doing business there immediately, but you learn people from there, how they think about things, and it actually broadens your horizons. So I'm a big fan of what Kaufman is doing. In terms of hard skills and everything, I wouldn't say it's about that. It's not like a two-year MBA program full time. It's more like a networking and value exchange, and background experience-based exercise that I would recommend for those who actually wanna dive deeper into what venture is about.
Okay, awesome. And well, listen, we'd love to share more deal flow with you. We're always looking for companies that are getting to that 100K MRR mark. And we like entry point to be at that point, which we refer to that as late stage seed. So it's pre-series A. And sometimes we miss that, and we're happy to have the entry point be series A. So as you guys have companies that are either hitting 100K or much more, 200, 300, 400, and they're still in that zone of series A, by the time they get to series B, the multiples we expect to get are not satisfying our small fund. If you 2x $1 billion fund, that's 200 million a carry that'll pay for the sailing trips and rent a Hinckley or buy a Hinckley. That's great. But for the smaller funds, we just do SPVs for the late stage, and we only SPV our own stuff. So we'd love to hear from Flint. We should set up a quarterly call or something to go over stuff and I guess primarily Israel, but it sounds like you're also open to Canada, Europe.
Right.
Coming here too. Well, listen, great to meet you. Thanks for coming on the pod, and
thank you for having me. Yeah, absolutely. Let's stay in touch.
Okay. All right. Bye for now.
Bye.